Welcome to the monthly 3-Edge View from the Edge for May 2025. I'm Fritz Folts, the Chief Investment Strategist here at 3-Edge, and joining me here once again today is Eric Biegeleisen, Director of Investment Research and Deputy Chief Investment Officer here at 3-Edge Asset Management. And as we do each month, Eric and I will provide our firm's most recent outlook for the global capital markets, which is based on our proprietary 3-Edge research model. Have a great deal to cover today, so let's get started. And as we know, tariff policies continue to dominate the conversation on Wall Street. This week, the Trump administration announced that its first trade deal was reached with the UK. Additionally, this past week, the Federal Reserve's Federal Open Market Committee met, and as expected, they left short-term interest rates unchanged. In his comments, Fed Chair Powell seemed to want to continue to set expectations around when the Fed may be in a position to lower interest rates, warning that the uncertainty surrounding tariff policies meant that the Fed could need to wait until there was more clarity before it would be in a position to make any monetary policy decisions as they continue to seek to, strike this balance between price stability and full employment. Powell indicated that the Fed was comfortable standing pat. Inflation is above the 2% target, but fairly well contained in the economy and the labor market we're holding up, at least for now. And so investing in this environment, as I'm sure Eric will touch on, continues to be a balancing act between protecting on the downside while capturing the upside. So let me bring Eric into the conversation here, and we'll see what our model research has to say. And we'll begin with the 3-Edge matrix of the major asset classes that we model. Eric, I will turn things over to you.
That's great. Thanks, Fritz. Yeah, a balancing act really is such a great way to describe the current climate that we find ourselves in. We can see here from the matrix, not a tremendous amount of movement, but notable that China is slightly positive, gold even more positive than we had an outlook last month, and cash. So, not super exciting in terms of, options out there, but we'll get into the details, I guess, and talk about why we view things the way we do.
Yes, we will. So let's review the model research and what it says about the various asset classes. And let's begin with equities and start with U.S. equities, which have now clawed back all of those losses from the April 2nd announcement. So what's the model saying at this juncture in terms of U.S. equities?
Yeah, we saw from the matrix, the model research has maintained that current outlook for U.S. equities is slightly negative. I sound like a broken record here, but U.S. equities do remain significantly overvalued by our measure, even with the sell-off and the bit of a rebound that we've seen. We're dealing with uncertainty, right? There's uncertainty around the Trump administration's intentions to impose tariffs on pretty much all of our trading partners, and that could no doubt lead to trade wars, currency wars, even and/or a surge in inflation. Each of which is a likely contributor individually, and much more likely, if collectively, to be responsible for an economic slowdown, a recession, or even a stagflationary environment, right? No growth, but with inflation. Without any signs of near-term resolution regarding tariffs broadly, but more specifically with regard to China, our research does suggest it's prudent to remain light on equities and to be diversified across asset classes at this time.
Yeah, absolutely. I mean, China, that's the big one, and we'll see what happens there. All right, well, let's shift attention to ex-U.S. equity markets, which certainly thus far this year have outpaced the U.S. Let's begin with Europe. What is the model saying there?
Yeah, absolutely. European equities have had a strong start to the year for the major equity markets that we model, helped out in large part by just a few large German corporations, but nonetheless, that's been helping out, broadly speaking, all European equities. Market momentum and positive investor psychology were those initial primary driving forces that we picked up on behind the rally in the European equities this year. But now they have this additional tailwind following the U.S. taking more of a back seat with regard to providing additional support to Ukraine. And this has led to the European bloc filling the gap with their own defense spending bills. And that may further boost economic growth in the region here in the near term. All that said, our yield curve measure for the region, while it is steepening, largely due to the European Central Bank's lowering of interest rates, it's not yet sufficiently steep enough to be indicative of longer term growth in the way that we measure it. So overall, our outlook remains slightly negative at this time.
All right. Well, let's shift over to Asia. Look at Japanese equity markets. What are we seeing there?
Yeah, so far in 2025, Japanese equities are positive, but trailing the other major developed international equity markets. While the shape of that Japanese yield curve measure that we construct, it is a negative factor, and that is weighing on the outlook. The the Central Bank of Japan has slowly been attempting to raise those short-term interest rates, but we haven't seen the 10-year moving up as well. That's been somewhat static. So you're getting this flattening effect on that Japanese yield curve, and that isn't currently supportive for economic growth. So again, outlook remaining somewhat negative here.
All right. Well, let's shift to the emerging markets then, including China. Another example of an ex-U.S. asset class with strong year-to-date performance, but obviously the tariff, that whole uncertainty will weigh heavily there. So what is the model showing us in terms of EM equities and China?
Yeah, this will be an interesting one to watch very closely. Emerging market equities are generally positive on the year, like you suggested, largely led by the performance of the Chinese equity market. We've seen a weakening in the U.S. dollar. It's down around 9% this year through the end of April, if you were looking at the dollar index. And that has helped, increase the attractiveness of emerging market equities more broadly. The proposed U.S. tariff measures on China are no doubt quite punitive, though the benefits of the weakening U.S. dollar may help offset this somewhat. We've also seen, more importantly, the Chinese government recently stepping in with a variety of stimulative measures. And that includes what they're calling tactical monetary stimulus, that is lowering their reserve requirement ratio, cutting interest rates, introducing this swap program. We've also seen fiscal support measures too. For example, pledges to deploy capital to stimulate growth, trade-in programs, a debt risk sharing program. All of this is likely a positive for China, with or without a resolution with the U.S. regarding tariffs, and therefore the greater emerging markets as well. So taken together, that's where we get that slightly positive outlook that we alluded to in the beginning.
It's interesting, in the case of China, it's nice to have a command economy where you basically just do whatever you think is needed. So let's look, one more equity asset class is India. I guess it's finally broken into positive territory, although the tension between India and Pakistan is a wee bit off-putting. So what does the model say?
Yeah, exactly. That was a great synopsis. Indian equities have rebounded somewhat in April, and they're now positive on the year. While the currency, the rupee, we've talked about in months past, that had suffered declines earlier in the year. The currency has regained ground, is actually now stronger even than it was at the start of the year versus the dollar. Beyond that, seeing well-behaved inflation measures, the RBI, or the Reserve Bank of India, India's central bank, has been able to make an interest rate cut, and that should be a positive for economic growth in the months ahead, particularly if that cutting cycle continues and inflation remains well-behaved. But like you just mentioned, we have to throw some cold water on all this with the uncertainty related to the recent escalation in conflict with Pakistan. And that no doubt will threaten, or has the potential to threaten, Indian equity market prices. So for the time being, the outlook remains negative.
Yeah, increasing tension between two nuclear powers, not
great.
Not the best. All right. So let's shift to the bond market and the current interest rate environment. So why don't we look at rates first and then corporate? So how are we looking there in terms of the model's outlook for interest rates?
Yeah, well, the outlook for inflation has been elevated due to the U.S. tariffs, which may keep the Federal Reserve in this longer-term rate pause. And the tariffs on our major trading partners may reduce demand for longer-dated U.S. Treasuries, which may result in higher yields, right? So these two factors together just continue to support this idea that we've been saying for some time, but the thesis hasn't changed, that concentrating fixed income investments in shorter-term maturities is probably the best place. With regard to credit, as we've said for some time, that outlook really hasn't changed. Corporate credit spreads are just still historically tight, despite even a few months ago we saw a little widening. That's maybe come back a little bit, and they're still, even at these levels, relatively tight, making that additional yield over and above the risk-free U.S. Treasury rate just unappealing, given the level of risk, the rising risk of recession.
All right. Excellent. All right, so let's now shift gears, look at hard assets or real assets as opposed to financial assets, and that would be both gold and commodities. And we can begin with gold. So what are we seeing there?
Yeah, gold maintains its status as one of the best performing asset classes in 2025. Tariff measures proposed by the U.S. along with the threat of sanctions have encouraged foreign investors and central banks to look for alternatives to the U.S. U.S. dollar-based assets. As gold is priced in U.S. dollars, a rising gold price is a reflection of a weakening demand for U.S. dollars. We've also seen investors' concerns over geopolitical conflicts and relations, even among our own allied nations, have helped to boost the attractiveness of gold as this haven asset. And should the Trump administration seek to follow through on their recently stated intentions to keep yields on longer maturity bonds, say like the 10-year bond in particular, artificially low, that could involve enacting government policies we've spoken about previously on these videos, known as financial repression, and all of this to say this could all just be a benefit for gold, hence the outlook moving up to that max bullish spot on our asset class matrix.
Yeah, absolutely. And I think you could get short-term corrections in here just because the price is so high, but yeah, your model still loves gold. So excellent. And then commodities, what are we seeing there?
Yeah, not a lot here to change. The prospect for this global economic slowdown, resulting from the threat of tariff and trade war, reduces the potential demand for commodities. The caveat there is something much more oil or energy focused. If geopolitical tensions in the Middle East, say, break out, that could be, where it might be nice to have a little bit of commodities in the portfolio that's energy intensive. But beyond that, the outlook kind of remains slightly negative.
All right. Excellent, Eric. That is a wrap. Thank you very much for your update on the market. Certainly seems like market volatility is here to stay for the foreseeable future. And we will, of course, keep all of our listeners and our clients informed as we make our way and navigate our way through 2025. So that will do it for this month's 3 Edge View from the Edge. Eric and I will be back again in early June with another edition of the monthly View from the Edge. If you'd like a hard copy of the View from the Edge newsletter for this month, that's on our website, which is 3edgeam.com. And as a reminder, our entire library of videos is available on our 3 Edge YouTube channel. If you think someone might benefit, please feel free to share them. And if you appreciate the YouTube videos, we would be most appreciative if you would be willing to subscribe. So, on behalf of Eric and everyone here at 3 Edge, thanks for listening.